Hi there, investors. Todd here. Welcome to Monday video. It's going to be April 25th. Just coming back from vacation. Want to get something out to you. Being in communication. Sorry for being quiet. I was on another trip. We were down in Florida as well as Turks and Caicos at beaches with the kids as a kids' vacation, and I wanted to just three quick update. Kind of explain how I see things. Sort of an outlook going forward, but. Coming back when I was a trader, I just had a rule: when you're away for a certain period of time, you always come back and take a day or two to get back in the flow of the market and just get caught up in what you've missed, see how the market is reacting, see what the news flow is, and just sort of get back in the flow. You just don't hop right back in. And that's what I did today, is really just spent all day going through all the news. There's so much out there, what macro is doing, what the sector rotation is doing, it's just so much going on here. Then we just got the news with Elon completing the deal with Twitter, so subject to final financing. But so much happening right now. So again, back from a trip. I've had about 3 trips in the last couple months. I haven't had 3 trips in probably 10 years. Sort of a mean reversion post-COVID. My trips are over. I'm here for the summer. Looking forward to being in Saratoga, working hard, being in more contact with you guys. I know Ryan's been working hard behind the scenes as well and in contact with you. So we're back at it. Let's kind of talk about it here. We're coming up into... we're in earnings season, and it's a big earnings week. About 1/3 of the companies are set to report. 1/3 of the S&P 500 companies are going to report. I've got these sorted by market capitalization. So Apple at 2.6 trillion. They're going to be on the 28th, so 3 days from now. That should be Thursday. Yes, they're going to be Thursday, the 28th. Microsoft is the 26th, so that Microsoft's tomorrow. Google's tomorrow, Amazon's Thursday, Facebook is Wednesday, Visa is tomorrow, Exxon, MasterCard, Chevron, Coke, AbbVie, Lilly, PepsiCo. We'll get about watch that one too, as Coke did so well. Staples have been doing extremely well. Healthcare has been doing well. Also Merck, Thermo Fisher, Comcast, AstraZeneca, blah, blah, blah. So, when's Intel? Intel is on the 28th as well. So, a lot of companies coming up here. Let's take a look at data as well. We do have some inflation data coming up here, end of the week. So, I like this Bloomberg calendar. So, 25th to the 28th this week. Tomorrow we have durable goods. We'll watch that one. Consumer confidence. We have home sales. Definitely want to see the housing data tomorrow. Wednesday, pending home sales, and then usual crude oil inventory. Preliminary GDP. Thursday, expected to be in a 1.1% growth, where the prior was 6.9. Of course, that's pretty significant. And then here's your inflation data on Friday. Core PCE, personal consumption expenditure, which is the Fed's preferred rate of inflation. Of course, that's what's driving everything in the market right now. So the PCE, then we have personal spending, Chicago PMI, Purchase Managers Index, consumer expectations, UMISH. So there's a lot of data coming up here this week, and earnings. So this is going to be a key week. A lot of decisions will be made. And, there was quite a reversal today in the market. And, I don't want to get too excited as to what is happening here, but I kind of feel like the Twitter deal sort of gave a pretty good boost to the market and sort of improved sentiment a little bit. So here's a look at the sort of the macro watch list that I stare at every single day. So the Nasdaq right here was up 1.3% at the close. S&P up 0.44. Dow 0.7. Pretty impressive there. Crude was down. We're still below $100. Gasoline below $3.20, so down 2%. Nat gas continues to go. We're doing a lot of export overseas here in nat gas, and I'm certainly interested in that. Interest rates are dropping. We'll talk about that. So there's some pretty good stuff happening. Bond market's gotten absolutely clobbered. We actually did see. Let me go back to that. We did see the AG, which is the AGG, which is a holding. If you have the fixed income portfolio, you have this. That actually put in a pretty good reversal here, up 0.2%. The AGG, U.S. Core iShares U.S. Aggregate Bond Fund. Even semis up 1.7% today. ARC Innovation up 3.6%. So interesting reversal here today. So let's talk about Fed rate hikes. We have a lot coming up here. There's some talk that we're even looking at a couple 75 basis point increases, which I find hard to believe. Let me just bring this chart over. So here's this is the way the market sort of trades based on expectations for what the Fed's going to do. So this is the Fed funds probability. So this can be found in the CME website. So at the next meeting, which is going to be in May 4th, we are looking for a move from the target federal funds rate of 25 to 50 basis points to 75 to 100. So they're gonna go 50 basis points, which is 0.5%. Then into June, from 75 to 100, they're looking to go another 50 basis points. So 75 to 100, up to 150 to 175. So they're even potentially looking at 50, maybe even 75 basis points in June, and then July up to 2 to 2.25. So basically, let's take a step back here and think about that. So they're looking at the Fed funds rate being between 2 and 2.25. 76% chance of that happening coming from the current, which is 25 to 50. So if you subtract 25 and 50 from these two numbers, it's 175. So basically what the market is saying is we're looking for a 175 basis point or 1.75% increase in the federal funds rate. And the market's assigning a 76% chance of that. And I think that's pretty interesting. I think that's good, and I love how the market is reacting to it. It's reacting extremely well. I don't like the sell-off, but if we look at the technical position of the market, it's still well within trend, and there's nothing here to suggest that we need to make a drastic course change. There are adjustments to the portfolio that I will be looking to make. Okay, so let's take a look at the FXI. So this is the Chinese ETF, and China has been under a ton of pressure as COVID cases are spiking. And from what I've read, there's several reasons to do with this, and specifically in Beijing, they're shutting the city down and doing some pretty massive widespread quarantines. But it's everything I've read from a lack of boosters being taken, vaccines being taken from substandard manufacturers. I guess Chinese citizens have resistance and don't want to take American vaccines that I think I think we can all agree are more effective. So there's a lot of reasons why cases are spiking, but the fact remains there is a lockdown happening in Beijing right now, and it's certainly weighing on things. But if you look at the FXI, the chart hasn't gone anywhere since, I'm looking back to 2017, and this blue chart is the FXI divided into the S&P 500. So you can see the FXI is dropping relative to the S&P. So Chinese stocks have been underperforming for a long time. Let's take a look at KWEB, which is the Chinese Internet ETF. So they're tech stocks. Same deal. We had a little bit of outperformance in 2019 into, actually COVID started in 20, right about here. So even here, they were outperforming, but then since February 21, just getting absolutely destroyed. So that's weighing on sentiment right now in Asia. Let's take a look, though, at the S&P and the VIX. So in blue here is the volatility index, and in black and white here is the S&P. And basically, the two trade inverse of one another. The higher the VIX is, usually the lower the S&P goes. And this is the fear index. When you hear CNBC talking about the VIX, this is fear of the unknown and fear of future volatility, and basically fear of selling off. The higher this goes, the lower the S&P goes. So what you'll see here is we did make a spike here in March 11th. The VIX got up to about 35 and then sold off as the stock market recovered. And what you'll notice is as the S&P is reapproaching the lows here, the VIX is nowhere near reapproaching the highs. Okay, so we only got up to about a 27, 28 VIX. And if it's truly as fearful as it was, and that we are going to make new lows, we should be back up here into the 30s here pretty quickly. And right now we're just not able to get it. And of course the Nasdaq looks weaker than this, right? So if I just put the Nasdaq in here, let me scale this quickly. The Nasdaq got very close to these old lows from February. As semiconductors did make a new low. The Nasdaq didn't, but again, the VIX is nowhere near those old highs. So I kind of take that as a non-confirmation that fear is so real that we will be going to new lows. I don't think we are, and I think the S&P is starting to sort of trace out an inverse head and shoulders, which is sort of a bullish development here. All right, so shifting to the Treasury, the yield curve. I was doing some spreadsheet work this morning looking at prior cases of yield curve inversion, which sets up recessions 12 to 19 to 24 months in the future. And I'm going back and forth with Wide Charts, who's my primary sort of data provider and platform that I use. And I'm not ready to say this is a finished product, just trying to go back and find proper interest rates. But what I'm doing here is going back and looking at yield curve inversions that set up recessions. And the big ones were September 2019, March of 07, August of 2000, January 90, and May of 1980. And the big thing that I've been saying is, everyone was talking about the yield curve inversion. So the current one is right here in orange, which is this guy right here. Yield curve inversion, which is the short-term rates. 2s, 5s, 10s are higher than 20s and pretty much the same rate as 30s. But there's been a lot of debate that's saying these short maturities, the 3-month, the 1 year, the 2 year, this is where you need to be looking, because the federal funds, where the Fed gets together and increases or decreases interest rates, depending whether they want to heat up or cool off the economy to moderate inflation and kind of handle their dual mandate of moderating inflation and maximizing employment, they're dealing at the short end of the curve. And if you look at the yield curve inversions of the prior, 1, 2, 3, 4, 5 different instances I looked at. So this orange one is September of 2019. Green one is March of 07. The red one here is August of 2000. And this orange crazy one is January of 90, right? So just look at the short end of the curve. Still very much steep in the current short end of the yield curve when you compare that to the prior. Okay, so again, that was September of 19. Green is March of 2007, setting up the credit crisis. And you look at this one, these guys are all clearly short-end yield curve inversions. 1, 2, 3, and not so much here. This one was January of 1990, so that was heading into the first Gulf War in 91. That was a very flat yield curve, but I think we could all agree that this one looks much, much different. Okay, this is what I've been saying all along. So I've been doing sort of some Excel spreadsheet work, going through trying to find the proper data to put in here. So I'm not ready to put this in front of you and say it's a finished product. There's another thing that I want to show you, which looking at the technicals of the bond market. Okay, a lot of people, if you're following me from the trade analysis days, you'll know that I really feel my way through the markets with technicals, which is looking at chart patterns. And I'm just pulling up the chart here as I'm kind of going off screen here. All right. So I want to go out here and show you how, a lot of people are saying, well, okay, the uptrend in the bond market is going to be broke, or it is broken. And again, if the bond market goes up, interest rates are going down. And that's generally a good thing, they say, for the market. If borrowing costs are going lower, more people can borrow, invest, consumers can spend in the economy, generating corporate profits. Corporates can borrow cheap money, do stock buybacks, invest in the company, infrastructure, employees, etc., etc. But they say when the uptrend is broken in the bond market, all right, and let's sort of define what an uptrend would be. That would be a trend line, okay? And real quickly, what that means is, you take your drawing tool and you kind of draw an arbitrary line below the lows, and you say, okay, I'm going to start here, go here. I'd say that's the line of best fit. And they say, okay, look, the bond market's, the uptrend's broken. But the reality is, guys, the uptrend in the bonds right here has been broken many times, yet it continues to go higher. Okay, and this is what I mean, case in point. So let's draw a trend line. Let's say here, we got a touch point here, you got one here. All right, let's extend it up. Look, it was broken there. If you continued at this rate of ascent, it was broken here. What did it do? It just went to new highs. A couple of the things that I think are noticeable here is the dollar's been very, very strong, which I don't take that as a bad thing. Usually a strengthening dollar is bad for our multinationals who export their products overseas, get paid in the foreign currencies. They get paid less money as they convert back to the dollar. But I take it as like a 1997, 98 thing where the world wanted to buy U.S. equities, so they have to sell the foreign currency, buy the U.S. dollar to buy our stocks. And also the rest of the world is in downward interest rate pressure. We have upward interest rate pressure. So people can borrow overseas very cheaply, invest in the U.S., and all of a sudden make 2.9% in a 5-year bond. They could borrow a quarter, borrow 0.5%, make 3% in our treasury markets, which that is going to, I believe, start to put a low into these treasury markets and sort of stem off these falling treasuries that I just showed you on that 30-year bond chart that's been going up for 38 years. So this is the U.S. dollar. Again, you could kind of just draw take your crayon out and sort of figure out where people might say the breakout is going to happen, which is right around here in the U.S. dollar, and that would continue higher. And again, I take that as a positive. I take that as a positive. Semis have come back quite well. I want to show you this chart. Semis did make a new low, but I would say that the momentum, let me get Bitcoin out of the way here. I'm going to bring this over in a sec. The semiconductors are here in green. So these are your chips, your NVIDIAs and Intels and AMD. So we are pulling back. I don't think there's a lot of urgency in this. I think we're still well within an uptrend here in the semis. And today was a day that was led by technology coming back. This is XLK here. The biggest upside on the XLK, which is technology. Fortinet, which we hold in our growth portfolio, which I will show you the portfolio. Fortinet was up 6.3%, but you look at the semis. Monolithic, semi up. Western Digital, semi. Teradyne, semi. Microchip, AMD, Lam Research, Qualcomm, QRVO. These are all semiconductors. So I love that we're seeing strength being led by the semis. Now, Bitcoin I also think is a risk-on sort of indicator. The better Bitcoin does, I think the better technology does. It's not an inflation hedge. It's a currency of the future that will be used in this new metaverse and with all these chips and all these this amazing bid that we've seen in semiconductors that are powering the new way we'll be able to interact online and in the metaverse and augmented reality and Bitcoin is just simply a a product that will be used in that new future. So if we could just kind of take Bitcoin in isolation, this is a common pattern, a 5-wave triangle pattern. Support should be right around 33,400 in Bitcoin. I do expect Bitcoin to continue to push higher. And if I could just show you the correlation between Bitcoin and the semis, as I'm saying, fundamentally, I think they're very, very related. If I just do a little scale job here, there's a bad tick over there. This is a bad tick. Okay, you just go out there and you can see the correlation between Bitcoin and semiconductors. It's unbelievable. So Bitcoin is not an inflation hedge. It's highly correlated to the growth risk on trade. Okay, I want to then also look at that growth and risk on trade here quickly. Just looking at the main value and growth ETFs that we track. Anything that's heading up into your right or is strengthening and gaining momentum and relative strength. Anything that's moving down into the left is losing strength and momentum. And basically what we're seeing here is against the S&P 500, the Russell 2000, which is small cap value, is moving down. The mid cap value is moving down. So this is small cap value, mid cap value, large cap value. It is on the right side of the XY axis, which means it is relatively stronger. It's been stronger, but it's showing signs of waning momentum. On the other side, you have large cap growth, mid cap growth, small cap growth starting to rotate into where you want to be. They're still a long ways away from doing this, rotating into the leading quadrant relative to the S&P, but they're headed in that direction. Okay, and I think today's price action is sort of indicative of that. So, energy was absolutely smoked today. Energy, let me just bring over the sectors here. Energy was down 3.3% today. Utilities down 0.7%. Real estate, materials, those are all the safety, risk-on, old-school value stocks where the leaders today were technology, communication, discretionary, and healthcare. Okay, so that's a pretty strong risk on day. Okay, let's talk about Netflix. Unbelievable loss in subscriber growth. A lot of competition in streaming. People are starting to figure out that they're probably paying more with all the different streaming services than they have in their one cable box. And in an inflationary environment, something as simple as this is pretty easy to cut off and to drop. So Netflix is absolutely been hammered. We're back to even sub COVID levels. We're 209, which, man, that wasn't even we're back to 2017 levels, which I'm absolutely fine with because we have dropped Netflix from our portfolio. I'll bring that over right here. So here's the current holdings of everything in our growth portfolio. And we don't hold any Netflix. We do hold some energy. We do hold some financials. And it might be time to start to look to get out of there. But, if you look at the history of Netflix, we launched in October with a 3.15% weighting. Dropped it to 1% when we rebalanced in February. Oh, sorry, that was Thanksgiving, November 24th. So we cut it, wasn't working, and then I dropped it on the February rebalance. Just got rid of it. So happy to say we don't hold any Netflix. Facebook, we still hold some. I'm going to look more into it, but the same thing. We started with a 2.15% allocation in Facebook, dropped it down to 1.25%, dropped down to 1%, and 1% is where we stay. Stock still has a lot of cash on the balance sheet. It's actually becoming more of a growth play. Tom Lee was making a great point on CNBC, trading, 11, 12, 13 times forward earnings. Let's take a look at that just to make sure here. Trading 15 times forward earnings with a 13.5 PE. So all that means is, you look at the estimates for what they're supposed to make next year. So the estimates is $12.16 for the year, and you divide that into the share price. 0.02 divided by 12.16. So that's 15.3 times forward earnings on the EPS. Okay, so the company has a ton of cash in the balance sheet. I can get into the financials, quickly here. If you take a look at, let's go. So Facebook has on the balance sheet as of the end of 21, they've got $66.7 billion in total current assets. Cash and short-term investments, so most of it is in cash and short-term. 48 billion of the 66 is in cash, and then you look at liabilities. So 67, and they have 21 in total current liabilities. Total liabilities of 41. So, so they've got 20-something billion in shareholder equity. So, it's actually become more of a value stock. We shall see what happens, but I think the sentiment and the mood that's happened, with Twitter and sort of big tech's sort of control on their way. They think the public conversation should be had. Privacy rights. I think this is very telling. Twitter is only the company only made $5 billion, or they only made $5 billion in revenue, I think, last year. $5 billion. Year before is 3.7. Their expenses are through the roof. I think they had minus 220 net income. Their operating income was 272 million on 5 billion in revenue, losing 221 billion point 1.13 before. The most they ever made was 1.14 billion. And this is on an annual basis. So, the market cap of the company is only, I think it's a $50 billion company, or $41 billion company now, right? Elon's going to do, I think, for $44 billion. They've got 217 million daily active users. 76 million of them are in the U.S. So 76 million is a percent of 330 million Americans. What is that? 1/6, is that right? So you have 1/6 of Americans on that platform. It's generating peanuts for revenue. It's become, I think, a utility, and I think we could have a much longer discussion on that outside of the scope of this video. But I thought it was super interesting what was happening today. Okay, so let's finish this off here. Yeah, we're gonna cut it there. That's the main thing I wanted to hit with you. But all's well. I'm just sort of mind dumping. I hope you don't mind. I'm just showing you some of the things I was going through today, and I am thinking about adjusting the portfolios here soon. I know some of you have cash. We've had discussions with each of you individually, and we have standing instructions with some of you to put cash to work, and we will do so as the time grows nearer. The market doesn't ring a green bell at the bottom and say this is it and go in. But I'm going to be actively doing this every day, watching the portfolios, watching the positions. I've got changes I want to make, so we'll be doing that in time. All right. Let us know if you have any questions, and we'll be in touch soon. Take care.